Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Thursday, August the 20th, 2026, and we have a genuinely packed show today. S&P 500 earnings momentum, a Treasury intervention reshaping yield expectations, Walmart and Deere both reporting this morning, and a historic crypto short squeeze that's pushed Bitcoin above $71,000. Let's get straight into it. Lizzie, S&P 500 Q2 earnings are tracking a 52% year-over-year gain. But how much of that is real versus Alphabet and Amazon booking massive unrealized AI gains on paper?
Morning, Robert. The headline number is genuinely misleading at first glance. Alphabet booked a $77 billion unrealized equity gain, and Amazon added $53 billion from its Anthropic stake. And when you strip both of those out, aggregate growth drops to 33%, which is still the strongest quarter since 2021, but a very different story from 52%. The mark-to-market gains are real on paper, but they can reverse just as fast as sentiment shifts on AI valuations. So strategists are right to flag that forward. Visibility is reduced when earnings are this dependent on asset prices rather than operating performance.
Even at 33%, that's still a solid underlying number. Does it change how traders should be positioning heading into Q3?
It does, because analysts have now lifted Q3 earnings growth expectations to 29.2%, and 85% of companies that have reported this cycle beat estimates. That's a backdrop that supports staying constructive on equities, but selectively. The rotation story is where the real trade is right now, and the technical picture for SPY and the S&P 500 reflects broader indecision. Both are sitting in neutral territory this morning with modest positive momentum, but no strong directional signal, so the index itself isn't giving traders a clear edge either way.
Morningstar is calling for S&P 8,000 within weeks after the index recovered all its July losses in just 4 sessions. Credible target or getting ahead of the fundamentals?
Morningstar's Dave Sekira is pointing to real catalysts: the bond buyback intervention, the earnings beat rate, and the rotation into software. So the call isn't without foundation, but from current levels around 7,700 on the S&P, you're talking about roughly a 4% move in a short window. And with futures slightly softer this morning and geopolitical noise from Iran sanctions adding uncertainty, that's an aggressive timeline, even if the direction is right.
You mentioned rotation. Money moving out of AI hardware names like SanDisk, Micron, and Western Digital into enterprise software. What's driving that shift?
The market is repricing which part of the AI value chain actually captures the profit, and the answer is increasingly looking like software rather than hardware. Silver Lake's reported takeover discussions with Workday acted as a major catalyst this week. And then the operating metrics from Salesforce and ServiceNow confirm the thesis, with Salesforce's Agentforce platform hitting $1.2 billion in annual recurring revenue, up 205% year over year, and ServiceNow crossing $1 billion in AI-related annual contract value, with agentic AI deployments up 9-fold, which is the kind of monetization proof the market needed to justify a re-rating of these names after months of underperformance.
Walmart reported this morning and slid despite beating estimates. And Deere also reported today. What do both results tell us about the broader market?
Walmart's result is a cautionary signal on the consumer, when the largest retailer in the country beats on earnings and raises guidance, but still falls roughly 6% because domestic same-store sales growth is slowing. It tells you investors are looking through the headline beat and pricing and a consumer being squeezed by higher gasoline prices and more selective spending, which has implications for the consumer staples sector broadly. Deere is a different story. They came in with EPS of 5.10 yen, against an estimate of 4.69 yen in a broadly weak agricultural environment. And that feels more like a stock-specific execution story than a green light for industrials, which has underperformed the S&P by about 12 percentage points over the past 6 months.
And how does Besant's bond buyback move translate into equity positioning for traders today?
The Treasury doubling long-dated buybacks from 2 billion to 4 billion per operation pulled the 30-year yield back from near 17-year highs, and lower long yields directly support equity valuations by making future earnings worth more in present value terms. But traders have to weigh that against the Fed minutes, showing a hawkish bias and US debt crossing $40 trillion. So the relief is real, but the credibility questions it raises mean you don't simply rotate all in on duration-sensitive sectors without accounting for those fiscal risks.
Steve, initial jobless claims are out this morning with a forecast of £210,000 against last week's actual of £209,000. Is the labour market still holding firm, or are we starting to see cracks?
The labor market is holding firm, but the trend is worth watching carefully, Robert, because last week's actual reading of 209,000 already came in above both the prior week's 200,000 and the forecast of 202,000, which means claims have now crept higher for 2 consecutive weeks, and this week's forecast of 210,000 would extend that modest upward drift. And while we're still well within historically healthy territory, the direction of travel is something the Fed will be monitoring closely when assessing whether financial conditions are doing enough work to cool the economy on their behalf.
Given the Fed minutes flagged a hawkish bias with many officials open to further tightening, how does the broader macro picture stack up against that stance right now?
The tension in the macro picture is meaningful. The Fed minutes from the July meeting showed many FOMC participants would support further tightening if inflation doesn't cooperate, but the data this week complicates that in both directions, because housing starts for July came in at 1.239 million, well below the forecast of 1.35 million, and a notable drop from the prior reading of 1.415 million, signaling that higher rates are already biting the housing sector hard, and with jobless claims drifting up, housing activity contracting, and analysts noting that recent soft data makes imminent rate hikes unlikely. The macro setup doesn't strongly support the hawkish case, even if the Fed's language still does.
Lizzie, over to crypto. Bitcoin surged above $71,500 on Treasury yield relief and Trump publicly backing the Clarity Act, but the technical picture is flashing overbought signals. Is this a chase or a fade?
Technically, this is a fade setup for new money coming in here. Bitcoin's RSI is sitting in deeply overbought territory and price is pressing right up against the upper Bollinger Band, which historically acts as a resistance ceiling. And while the volume surge shows real conviction behind an 11% single-day gain, with somewhere between $2.7 and $3.3 billion in bearish positions wiped out in what Fundstrat called the second largest short liquidation in history, the question now shifts from whether shorts are forced to cover to whether genuine buyers step in and sustain the move at these levels.
What about Ethereum and Solana? Are they in the same technical boat?
They are, and in some ways, the overbought readings are even more stretched. ETH gained roughly 19% and Sol over 13% in a single session. Both carry a lean bearish technical bias with RSI readings even deeper into overbought territory than Bitcoin, and price pressing their own upper Bollinger Bands. So for this rally to hold across the board, you need spot buying to replace short covering momentum, stablecoin liquidity, to rebuild on exchanges after falling roughly 20%, and critically, the Clarity Act Senate cloture vote on September 15th to stay on track, because a meaningful portion of this move was priced around that regulatory catalyst. And Reuters is already flagging real headwinds from a crowded legislative calendar.
Trump also hinted at the government directly purchasing Bitcoin at a sizable scale. How seriously is the market taking that, and what does it mean for crypto-linked equities?
The market took it seriously enough to push Bitcoin above $71,500 and send Strategy up nearly 10% pre-market, alongside Coinbase gaining over 7% and several crypto miners posting solid gains. So the signal landed with real weight, though the nuance is that Strategy itself didn't actually buy any Bitcoin last week. Holdings are flat at around 840,000 BTC, and there's an additional risk that MSCI is reviewing whether to exclude Strategy from certain global equity indexes, with a decision expected by mid-October, so that name specifically carries meaningful headline risk, even as Bitcoin benefits from the broader government buying narrative.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research. And don't forget to subscribe so you never miss a morning. See you tomorrow.